So hello everybody, my name's Tom Murphy. I'm a partner here at MSMF. Joining me today are two of our most talented financial advisors, Nick Mengel and Kevin. Nick and Kevin, thanks for being here today.
Thanks for having us.
Thanks.
All right, so this is the first in a series of podcasts that we'll be doing for you. We'd love to see you, we'd love to talk to you, but understand that time sometimes is challenging to get into the office, but we're here for you. So again, this is just a one in a series. There's certainly plenty to talk about. Certainly the market has had a couple of really positive days. The Fed rates have gone up. We've seen that, right? Recent news, gone up 0.75 of a point. The second quarter GDP, again, negative again. But let's start with consumer confidence. Nick, it seems like it's at an all-time low.
It is actually. Pretty crazy when you think about what we've been through. I started right before the Great Recession. And somehow consumers are feeling like the situation we're in now is worse than that point. But not only that, but even worse than other major events, even going back to other periods when we saw high inflation, which is kind of probably the key driver of this one. But even back in the 80s, we didn't have confidence at this level. So it's pretty fascinating when you look at the other economic factors and what's going on, and there just really seems to be a big disconnect between those two.
So when you think about other economic impact, data points, what do you think? What are you talking about?
Sure. Unemployment, wage growth. We've seen unemployment at very low levels, pretty much as low as our charts go back. Wage growth is as strong as it's been, through this cycle, at least since it's been in the 80s. So really fascinating to see, companies are producing good earnings numbers. Consumers are overall in a pretty strong position, but there's just this overall fear that inflation is just going to do us in, and all the headlines about recession talk.
Kevin, you want to expand a little bit on unemployment, specifically on wage growth?
Right. So unemployment, we're sitting around 3.5%. So if people want to be employed, they have a job out there for them. And like you said, wage growth is at 6.5%, which is well above the 50-year average. So, there's just a major disconnect between the data. And like Nick said, I think inflation and just the constant negative news out there about recession is gotten into the consumer's head about, where the economy is going, the direction we're in. So I think the further you look into the data, the more it supports that, yes, we may be in a slight recession, but it's not going to be anything major.
When you think about that consumer confidence and the impact on the VIX and what that does,
Sure.
So do you want to talk a little bit about that? Because sometimes that can play into these big swings we see in the market because of how a lot of the algorithms are built around, how the trading is done.
Sure. Yeah, we saw you mentioned the Fed rate going up 75 bips. That's fascinating to see on a day where the market was up 2.5%.
Absolutely.
And just absurd to see those two things happen on the same day.
Because typically they move in opposite directions, right?
Right.
So.
Your rates are going up. People think, okay, well, my bonds are going to do better. My stocks are not as favorable. And, I think the market was very well priced in these expected changes. That was very well expected, probably another 1% by the end of the year. But as things come through this cycle, they should be starting to ease off, going into 2023. We're going to go through this cycle. You mentioned a recession. Are we in one now? Is it going to happen next year? It doesn't even matter. It's all going to, when we see these dips in the consumer confidence, we see strong returns from the market in the following 12 months. What was the number on that? Our average on that?
Yeah, 25% on average.
Right.
From the
so
charts,
obviously it's no guarantee, but and you say don't catch a falling knife. Well, this is pretty much as low as it's ever been. I mean, it's hard to say. It could obviously go lower, but we got to be close to a bottom on that chart at least. And I think we've seen some of that. It's more of a backwards predictor, but I think we've seen a lot of that bounce as the markets come back, really strong this week.
Kevin, Nick talked a little bit and mentioned bonds and the correlation normally we see between bonds and equity, right? They normally are kind of reversed. They're not correlated. But what we see about this is that when it's been down, they're both down, right?
So that's what's been unique about it. And I think it shows there's been nowhere to hide within our portfolio. So, just staying in an equal balance, based off your risk tolerance is important, and keeping that, in a target line where you want to go, it will be important as we get out of this time period.
Yeah, the key is discipline, right? And emotion, and certainly not overreacting, right? So there's always going to be different data points. There's always going to be different things to point to. At the end of the day, it comes down to that discipline, have a disciplined approach, right? Fair? So,
Absolutely.
well, again, we want to hear from you. We want to know what's on your mind. Certainly, we're always available for a phone call or for you to come in and visit. We'd enjoy and appreciate that. So with that, again, thank you for your time today, and be looking for more podcasts in the future. Have a great day.